Hi, folks. This is Mike Zlotnik, Big Mike, and this is the quick commentary on today's Federal Reserve meeting and the decision to raise interest rates by 0.25%. So the short version of it is that it's the move in the right direction, but Federal Reserve has certainly taken a more hawkish approach. Of the 8 voting members, I think 7 voted for a quarter increase and 1 voted for 50%, 50 basis points increase, which is, again, obviously a very hawkish position. Everyone was expecting the Fed would move the rates up about 50 basis points, and the Fed has decided to be more careful. The stock market is happy today. Again, Wednesday, March 16th. However, the projections have moved that the rates will go up by the end of the year substantially from this point on. Approximately 7 quarterly increases is what is in the projections. So the fresh projections by the end of the year, the Fed's rate should be somewhere around 175 basis points, 1.75%, which is a substantial increase from where we are today. And by the end of 2023, the rates are projected to move up all the way to 275 basis points, or 2.75%. These are massive moves. One of the most important comments is that on the absolute basis, these increases don't appear to be large, but on the relative basis, where the Fed rate was before near zero, these are very substantial moves. So I would still caution folks that the Fed is likely going to continue to look at the data, and especially at the inflationary data. So the US economy is in full employment. We are essentially at a period of time a very low unemployment rate. And as a result of that, we're dealing with accelerated inflation. So the inflation, well, inflation is not only driven by very low unemployment, but certainly wage inflation is impacted by very low unemployment. So it's a good news. The wages are going up, but we're also dealing with a very substantial inflationary environment. The last reported figure was 7.8%. CPI, and that generally doesn't even include food and energy. And food and energy have seen much higher inflation. So we're dealing with the period of a double-digit inflation effectively. So the Fed almost has no choice but to raise rates. They're just more cautious today, given the war in Ukraine. And my 2 cents is that I would expect Fed to continue to increase rates over time throughout this year, and obviously be slow and responsive to what the market does. They may slow down if they see data-driven results that the market can't take any more of these rate increases. The stock market shows substantial volatility, or other types of data that's going to come in that's going to look very disruptive to the US economy. Always remember that Fed is always late. They seem to miss the party. When they show up late, and then they do things, in my view, too slow and sometimes too much. So at this point, I think they're trying to be slower and more careful, and want to make sure they don't overdo it. The ability to raise rates as much as it is necessary to slow down the inflation, at the same time, they don't want to put massive brakes on the US economy. And I think that's why they're being more cautious, given what's going on in the world. Appreciate your time and attention. Just a quick commentary, and talk soon again. Stay well.